Celsius, what's it worth? Where's it headed from here? Is it going to be trending flat, up, or down in the near future? Today we're going to be finding that out in this video. We're going to start with some of the fundamentals, and then we're going to run a valuation to see where the stock could be headed from here. So ticker symbol CELH for the USA stock of Celsius Holdings. We've got price per share of $91.07, a price to earnings of 118, a market cap of 21 billion, and an enterprise value of 19 billion. Looking at the financial strength, we've got a cash to debt ratio of 345. So for every dollar of debt, they have $345.67 of cash to pay down their debts. When we look at their profitability, we see all across the industry fairly strong margins, and versus history, green. So some of the best margins they've had in their historical performance over the last 10 years. The highest for gross margin, the highest for operating, the highest for net margin, and their free cash flow is at 9.39, whereas their highest in the last 10 years was 15.29. So very strong margins for the business versus the industry. They're in a very good position. I use these margins to tell me something about the business and how the business is performing, but I use ROE, ROA, ROIC, and ROC to tell me about management strength. And then again for these, I see highest in the last 10 years, and as well as the industry performing fairly strongly. When we look at the price to earnings ratio, we do see that their current of 118 is well above their minimum, but below their median. So buying this company for around 19 price to earnings would be more favorable than at 118, but today they still are below their median. When we look at the trailing 12-month revenue, they have $1.3 billion in revenues against that $21 billion market cap. So just about 20 times their trailing 12-month revenues. Looking at their financials on a trailing 12-month basis here, we see that revenue is steadily increasing over time, so a great sign there. Net income is in the positive now and has been since the third quarter of 2023. So decent signal here. We do see that they have very little debt in relation to their cash pile. So they have 756 million in cash, 2 million in debts. So very good position there. And we do see share sales, so diluting shareholder value. So not a great signal seeing share sales, although usually when companies get older, they do buybacks. So for a younger company like this, share sales is not quite as pessimistic of a scenario. We can see that this business is a single segment and its main operation is in the United States with some sales in Sweden, Europe, Asia, although those are very marginal. And right now it looks like the company is mainly selling its products in the United States. So this could leave room for expansion into other countries, which it looks like they're starting to do. But to see what the company's worth and what's currently priced in, let's run a DCF. So in here we see 1-star business predictability, probably due to there being no 10, 5-year data for free cash flow or earnings per share. But on a 3-year average annual rate, they've grown at 195% for earnings per share, and for free cash flow, 242%. So serious amounts of growth here for their 3-year average period, although it hasn't been around long enough for us to have 10 or 5-year average rates of return. So lots of growth. Let's see what's currently priced in for earnings per share. So currently for earnings per share, there's about 40 to 41% growth priced in for the next 10 years. And that is a substantial amount of growth to be priced in, but anything over that is going to result in upside, at least for a fair value, and anything below that 40% is going to result in downside. But that's just fair value, and the stock could always trade at a premium to its fair value or even a discount to its fair value. So looking at free cash flow here, so currently for free cash flow, there's about 46.5% growth priced in. So there is lots of growth priced into the business. Not saying that it couldn't keep growing from here, or that its stock couldn't trade at a premium to its fair value. But as of right now, I don't see this as a particularly cheap business. Looking back with that 118 price to earnings ratio, obviously there's going to be a high amount of growth priced into the business. And with it being sitting around $20 billion market cap, I mean, the stock could still double, triple from here. But if there's any deviance from their growth estimates and the expectations, then we could see a little bit more volatility. So it doesn't look like a cheap business or a screaming deal to me. But with that being said, that's my opinion. If you enjoyed these type of videos, please leave a like, subscribe, comment, and I'll see you next time.